All righty, welcome everybody. It is Tuesday, June 18th, 2024. And this is our Income Navigator trading and segment. And myself and Igor, hopefully Igor, I'm not sure if he's on here yet.
I'm on here.
Oh, there you are. I didn't see you. So Igor and I are in here. We're going to just answer questions for you guys. We'll take ones that are specific. There's a handful of things in the Discord channel this morning, so I wanted to touch base on a few of those as we go through, and I'll let Igor take a couple of his area, and I'll touch base on a couple of questions that were to me, and then anything that was kind of just said out there, we'll both jump into. But one of the first questions that I got this morning was a little bit. It was related to allocation of my trades that I have, and I'll cover it briefly with you guys. In fact, I will share my screen. You can see my screen, and then I'll jump into it. So. All right, and the question was, well, if futures or if Strangles are so doggone good and have a great return on margin, and again, I'm going to have you guys stick off video just so that we don't have it blocking the whole screen. But if Strangles are so great, why am I only doing 15% of my account to it? Why not more? And I think there's a couple of reasons for that. And it really comes down, for me, to your risk tolerance and what your goals are. So when you're creating a trade plan, the first thing, in my opinion, is you come up with why are you trying to trade. The second piece of that is, well, what's my goal? What am I trying to accomplish? And really, I want you to be specific when it comes to these, but what are you trying to accomplish and by when? Right? So how much do you want to make? What's the account size now? How much do you want to grow it to? And what's the timing on that? So let's just say you have a $100,000 account and I want to get it to $300,000 and I want to do that in 10 years. Okay. I can re-engineer exactly what the monthly percentage would be to grow it that big. Now, we know that at 3% a month, we double an account every 2 years. And we also know that at 2% a month, we double our account every 3 years. All right. So if I was at if I wanted to grow, my account and double it in 10 years, then I would obviously be looking at something along the lines of maybe a 1.5% a month or something like that. But for my trading portfolio here, my goal, which I have published a couple times, is I would like to double this account in the next really 3-4 years. Okay, so 3 more years, I'd like to double this particular account. So this trading account, we're trying to double it, and at 3%, that allows me to double every 2 years. Okay, so I'm hoping to double this account every 2 years. It's up to 500,000 now. A couple of years ago, it was at 250. A couple of years ago, it was at 100. A couple of years ago, before that, it was at 50 or so. So I'm on that path to it. But I'd like to double this account in the next really 2 to 3 years. I don't need to hit 3% to do that. I only need 2% to do that, to double in 3 years, which was technically the goal here. But let's move that goal up a bit. But because of that, I only need 3% a month. Okay. The long-term 112s are the core of what I do. And those are going to get the largest allocation. Those are going to allow me to grow my account at a pretty good pace. Okay. Right now, it's generating $7,000 a month or more. But let's just say it's generating $7,000 a month for me right now, which is about 1.5%. So 1.5%, half of my money is generated through the long-term 112s. Okay. And the risk on those, to me, is not that great. They have a very, very high win rate. There is, the risk is only really some kind of a black swan event. Okay, there's not a ton of risk in those. Okay, then 112s on futures, pretty much the exact same risk, even at 60 days, that's generating another $3,500 a month for me. All right, so now we're talking maybe a 0.7%. So when you add those two together, I'm generating over 10 grand in my account, okay, which is 2% of my account is being generated by 112s. Right, so Strangles, I don't really need to generate a ton of cash for me, so I really don't have to do it. So really the number one reason is I think there's more risk in Strangles. They have a lower win rate than a 112 does. A 112 has doggone near 100% win rate, okay, or very, very, very high, upper 90s win rate. Strangles are 88 to 90% win rate. I also know that if I lose one strangle, it does take out about 3 other potential trades. In there, we still make good money on strangles. We're still generating good cash. But for me, the reason I don't use more of it is simply no sense taking on the additional risk. With strangles, most of the risk, most of the time, is to the upside. Sometimes it can be to the downside. I think it's 50-50 either way, but most of the time it's to the upside, and you're selling naked calls, which I don't always love, but I'm just playing the probabilities and setting up a strangle. So I could, if I wanted to be a more aggressive trader, okay, I would probably do more strangles. If I wanted to grow my account at 4 or 5% a month, I'd probably allocate most of my money to strangles. Okay. I think it's a great trade. I think you can size up. I think you can add more of your allocation. But for me right now, 15% is totally fine because I'm making good money with the other allocations. Maybe that's not the exact answer you guys want to hear, but for me, it just makes sense to leave it at 15. I like it because it's a good juicer to my returns, but it's not it's not the lowest risk trade. So I'm trying to balance out risk and reward, and that's why strangles are about 15% and not moving that up to 25% or so. Could I do that? I absolutely can. And I could move it up. I could double the amount of money that I'm returning from strangles. Now, the last thing I want to mention here too is when I allocate my portfolio, and I've mentioned this a number of times, but for those of you that are newer here, maybe you haven't been on some of these videos, these are also my minimums, okay? So I'm assuming that I'll have 50% of my buying power available, and then this is the percentages of that 50 that I'm using. So 50% of the 50 is in long-term 112s. 25% of that 50% is in 112s. 15% of that is here. Those are my minimums, and I'm looking to spend $37,000 on strangles. Well, if you're paying attention or you're looking at this portfolio spreadsheet, or if you're just following my trades and what I'm doing, you'd know that right now we are sitting on 9 strangles using approximately $113,000 in initial buying power. Okay. But Tom, you've only allocated $37,000 for this. Again, that's the minimum. Okay. I start in order. Number 1, do I have the minimum amount of long-term 112s on? I do. Okay. So I don't need to add any more. That's my campaign style trade. 112 on futures, I can allocate up to 62 or at least $62,000 or more. Okay, I'd like to generate somewhere in the neighborhood of about $3,500 a month on those. Do I have those? And am I allocating that amount of money? So I'm allocating, at least right now, of these 3 that are open, this is somewhere in the neighborhood of 60-some thousand. Well, actually 60, 70, almost $80,000 right now. So I'm allocating enough for my 112s. Okay. And so I have money, and I've already got my 120-day trades on. Okay. So I have extra cash. Where am I putting my extra cash? Well, I'm not going to put on more of the ES long-term 112s, so I can use this for any of these discretionary trades, including spec trades potentially. Okay, so I choose to add more strangles. So technically, I am over 15% of my account in Strangles right now, but that's the minimum that I will spend, but I won't add more unless these first two columns are, or first two rows here are filled. So I hope that makes sense on it. Let's move on to the next thing. So there's some questions I know for Igor, but Igor, I'm going to let you jump in on the next one here. And one of the questions, Igor, for you was, how do you hedge your 112s? Okay, I know somebody put edge and then everybody else jumped on that, but it really wasn't the word edge I think they were looking for. I think everyone was,
Oh,
the question was about hedging 112. So Igor, do you hedge your 112 trades?
this is a great question, and thank you for correcting this. I guess I read this wrong as well. I thought, someone said
It might have
where.
been edge, but I think he was intimating hedge. So
Right. And, as you know, and most of you guys, hedging is a very popular and over discussed topics. Hedging is, we can talk about hedging for days here. But the idea, right, and this is what I said earlier today, is that, our trades, we are in a business of exchanging premium for somebody else's risk. We take on the premium, and with that premium comes the risk, right? So we take risk off of someone in exchange for some premium up front. And as long as, right, the underlying doesn't go past, whatever our risk, which is defined by, the strikes that we select, as long as our business doesn't blow up, so to speak, we get to keep the premium, and that risk eventually will go away. Now, we collect a certain amount of premium, right? And we only have so much to spend to make any further hedging for our own risk, right? So, and I think that a lot of times people don't realize that they focus so much on hedging because, whether they're afraid of a black swan or it's something that keeps them up at night, that they will over time spend almost all of that premium that they're collecting, and they end up in the end with very little or maybe even no profits. I have seen cases where people would, collect some premium up front. They sell strangles or straddles and whatnot, and then they would try to buy black swan hedges, and they don't realize that they spend way more over time than the premium that they collect. So they end up kind of with a non-profit as a business. That's not what we want to do, right? So in order to avoid that fear of the black swan or whatever may be keeping you up at night, as long as you have a decent trading plan with a very clear point where you need to stop out of your trades, there's really no need to hedge your 112s. Because if you just think about what is a 112, a 112, in the one lot, it's two naked puts, but those two naked puts that are short, they already are being hedged by a closer at the money put debit spread. If you add any more to it, right, you're probably giving up any premium you're trying to collect up front, which is the tail profit. And then the best case scenario is that the underlying is going to end up somewhere in the trap, which is between the put debit spread and those naked short puts. And that's where you're going to make money. Now, if we are in a kind of an slow uptrending market that we're seeing right now, right? We're at all-time highs. If you continue to hedge your 112s, you're probably making very little. Maybe you're just breaking even on those 112s. I don't think it makes sense to do those trades altogether. So don't focus too much on hedging your 112s. Rely more on your trading plan and your ability to stick to it. And then you don't have to really worry about hedging any of your positions.
yeah, anybody have any follow-up questions on that? So Igor and I are very similar in this. We don't get into hedging discussions much because it's just trading, and we have a trade plan, and we just follow our plan and we follow our stops. So that's pretty much it. If you're trading, and you've got your trades on, follow your plan. If you follow your plan, you're going to be okay. Okay. And you can't, just spend your life worrying about the black swan thing. And if you do, and it's keeping you up at night, as Igor said, put something on. So Igor, my question would be, what happens if the market starts to just go south and we're dropping 2% a week every week for 3 or 4 weeks, or we're dropping, we have a 4% down week or something? What do you do if the market starts to really go south badly and we're starting to hit all of our stops? What do we do?
That's a great question. And I think that, we need to think about our positions in terms of diversification over duration. Meaning, for example, I'm holding a number of 112s right now, and I have in the Schwab span account, I have 13 112 positions in ES. That's just ES, right? So let's just stick with that. So 13 positions. And then if you look at the 13 positions, I have some that I put on my latest ES 112 I put on yesterday, right? And then the oldest 112 that I have that's coming off in 3 days. So as you can see, right? So yesterday's trade has 94 days until expiration, and the oldest 112 that I have has 3 days to go. It's been open for 91 days. Now, if we just imagine a scenario where the market starts to go down 2% a week, which is really not too aggressive. I know the VIX is fairly low, and 2% a week may sound like a lot right now, but it really isn't. But if we do start to go down without any kind of retrace back to the upside, yes, it's going to put a lot of pressure on some of the newer 112s. But the older 112s, right, those that have 3 days, 10 days, 14 days, 20 days until expiration, if you have not removed the naked puts, which I like to do, right, removing those naked puts at 90 or 85% of their max potential profit leaves those put debit spreads, which are going to expire. Those put debit spreads are now acting as an insurance for some of the newer 112s. That's in my case, right? If you don't do that, then you need to figure out, all right, how close are you to your stop loss? If you're within a couple of $100 to your stop loss, let's say if you need to stop out of a trade when the trade is down $3,000 and you're at a loss of about, I don't know, $2,700, you can play that game of chicken and wait to see what happens tomorrow. But there's always a chance that, the market may open down 2% the following day and completely blow through your stop. For me personally, if I was in that position and I didn't have shorter duration put debit spreads that are kind of holding things together, I would just stop out of a bunch of trades. Clearly, with the market going down week after week, 2-3% back-to-back weeks, that's not my best kind of market that I like to trade. I will stop out of my trades. I will preserve financial and mental capital, wait it out. Maybe it's a month, maybe it's 2 months, maybe it's 3 months. Just, go light, go easy, stop out of trades that need to get stopped out of, and wait for things to settle back down, because we know they will. Right? You go back to COVID. COVID was crazy. Market was limit up, limit down, limit up, limit down. But then 6 months later, things have settled back in. If you didn't pull the plug and get out of trades that needed to get closed and you blew yourself up, guess what? 6 months later, you are out of the game because you have no more capital to trade with. You didn't preserve any capital. So for me personally, I like to trade when VIX is quote unquote low, right? Things are kind of like where we are right now. VIX is at 13 and 14, and market is not really implying too much. So there's plenty of money to be made when the market is kind of leveled. When things get crazy, if I need to stop out, I will do so and wait for things to settle back in, and that's when I go back to work.
Cool. All right. Good. So hopefully that gives everybody some idea. Again, we're traders. We follow our plan. If the market starts to go south, we start hitting stops.
I want to add one more thing.
Yeah.
and this will kind of tie in both questions together. So Rob has been posting a lot of great content on Discord. His hedging, right? It's kind of a system where it's a process that you follow, right? You sell some puts, you buy some puts, and eventually you end up with this kind of a free black swan hedge. So, and it, if you are going to go down that path, right, these black swan hedges, they're not designed to any specific trade or to any specific account size, right? You need to figure out how much of that hedge you may need for your account. But if you run these hedges that Rob talks about long enough, and you end up with an inventory of a bunch of free, way out of the money puts that you're holding, and those puts are going to cover your account if the market goes down 30 or 40% in a matter of maybe a couple of weeks, maybe a month, right? Kind of like a COVID crash. But again, if you're going to sit around waiting for, COVID crash type of market, you'll scare yourself out of a bunch of trades, and in the end, you'll never be able to trade as a business, right? You'll never go big enough to make it worthwhile, or you'll just sit out waiting for the market to pull back so that you could jump in. If you need a black swan hedge, you could put one on and assume that if the market is going to black swan, right, the black swan hedge is not going to make you a millionaire. It's going to reduce your losses, but losses will be there. So rely on your plan first. Have a black swan hedge that will help you kind of relieve some of that financial loss that you're going to take on. And again, I can't say this enough. Rely on your trading plan, right? If you have a stop, honor your stop. Don't negotiate. Don't look for reasons to avoid or skip your stops. Follow your plan. It's proven, and Tom is a good example and has been doing this for a long time, and he is showing you day in and day out that he has a plan, he's executing his plan, and it's working long term.
Well, there you go. On the same point, though, I do have long puts on. I don't have a ton, but I have enough to offset significant losses if they happen. I am not trying to make money and retire on a black swan event. I am trying to just mitigate some significant damage. And I'm honestly, I've said it before here too, if I wasn't running a service, I'm not sure I would have the hedge. Okay, so I'm being responsible to make you guys responsible more than anything, but I don't do the free black swan because there is no such thing. So you guys all know my take on that. But I'm sitting on 14 long puts that are a drag on my account, but I assume the drag and I overcome that by adding some additional strangle trades or zero DTE. I closed the zero DTE trade today. And I don't know, whatever that, what we booked, $450 today. So you close a couple zero DTE trades or something on a monthly basis, or a spec trade or something. And I know Christoph posts a couple stock trades periodically, on Nvidia or Tesla or SMCI or something. Fine. You want to take a little flyer on a couple of those things, or you want to jump into active trader and throw a couple trades on. You make a little money on something, buy a hedge. Okay, but your hedges all cost you. They're not free. So I hate the word free hedge because there is no such thing. Okay, they were all paid for by something that you sold and then closed early on. So you're always going to be short until you close those open puts anyway. So, or not short, but you're always going to be exposed until you close them all.
Mm-hmm.
Then you have an inventory left. But how you pay for those long puts is up to you. I just pay by winning. Okay. Some people want to pay by putting on specific trades that they'll take off. I don't care where the money comes from. Just put the trades on. All right. So next question was potentially when to add a BA 112 trade. So I'll go into this briefly. I don't want to spend a whole lot of time on it. But if I'm looking at ES, so let's take ES for an example here. And I prefer the weekly chart because most of my stuff is longer term. Okay. And there's a video in the members videos called, how we trade or whatever, the BA 112 and the FB. Uh, you don't have to call them anything. They're still just 112 trades. They just have different shapes. They just have either wider put debit spreads, or the naked puts are farther out just to pay for them. But typically the BA version is a 50 wide. The FB version is like 100, 200 wide, 250 wide, whatever you want to call it. Let me get off video so I'm not looking up the screen. You guys don't need to see pictures of me. Okay. But when would you put those on? Well, as I mentioned before, to me, the BA comes first, okay? Because the FB is when momentum is starting to pick up to the downside. You want a big fat trap. The BA kind of sits out there and doesn't cost you much of anything. It uses up buying power, but you're not making any real money on it. And it's okay to just give you like a little bit of extra protection. It's not a huge hedge, even though we categorize it as such, but it's just a way to capture some downward movement. But if we look at the weekly chart here on the left, and Igor can chime in, I'll cover two birds with one stone on this as well. But I mean, to me, this looks like an uptrend. Okay, so this is an uptrend on the weekly. It's an uptrend on the daily. All right, you've got the 21 well over the 50, well over the 200-day moving average. You've got MACD rising and breaking above the zero line, so they're crossing here. You've got RSI rising, even though it is in overbought territory. We stayed in overbought territory here from January all the way to April. Okay, so we stayed overbought for 3 months. So you can stay overbought for a long period of time. This is a 3-month period where the market kept going up. So just because we get to overbought doesn't mean the market can't keep going up. I mean, if everybody would have started selling or buying puts here, you'd have been in a whole lot of hurt, because we kept going up for 3 more months until we finally came down, touched the 21, and back off to the races we are. So just because we're heading north on the RSI doesn't mean the market's going to roll over. And then if you look at the squeeze, again, it's the least of the indicators that's important to me. I like MACD number one to give me a sense of momentum. MACD is just telling me, are the distances between the moving averages getting wider, which means we're accelerating to the upside? And if that's the case, momentum is going up. So I'm a momentum trader. I'm a reversal trader and a momentum trader. Okay. So number one, if MACD is rising, the distance between technically the 12 and the 26 or whatever are moving wider apart, okay, which is being shown by the signal line in red, the 9 being crossed over by the average of the 12 minus the 26. Anyway, you can visually see the fact that the 21 is distancing itself from the 50, which is distancing itself from the 200. That does not look like a slowing momentum to me. Okay, I don't know. It doesn't take a genius to figure out that this is pretty good uptrend. Okay, now the squeeze also gives me a sense of momentum. Okay, and what is the squeeze? The squeeze is essentially what happens when the Bollinger Bands get inside of the Keltner channels. Now, I don't have the standard Keltner channels and Bollinger Bands on here. This is a 3 ATR. So in white, this is a 3 multiplier on the Keltner channel. But essentially, all the squeeze is, it's taking, the Bollinger Bands and the Keltner channels and giving you a sense of what the volatility is. So when the Bollinger Bands move inside the Keltner channels, which means the Bollinger Bands are tightening, the market's in a squeeze, which means volatility is coming out and it's starting to get coiled up like a spring, that if it breaks out, when those Bollinger Bands break out of the Keltner channel width, then volatility could expand and the move could be significant one way or the other. And then we use these colored dots because there was a question on the squeeze earlier, and Candy's got a nice write-up on it. So if you just go to Candy's Corner and you look at the TTM Squeeze or Squeeze Pro, this is the Squeeze Pro with a different coloring scheme. But when it's white or red, for me, you're in a squeeze. As soon as it turns green, that means the squeeze is over. It's no longer squeezing, but the momentum has, it's fired. The squeeze has actually fired. So you can see back here, we were in a nice squeeze. Boom, on this green bar, the squeeze fired. And typically 8 bars is how long it lasts on average. Doesn't mean it can't last longer. Okay. And then when the dark blue is happening, that means the breakout of those Bollinger Bands from the Keltner channels are starting to come back down, which means the volatility is coming out, which means the momentum is coming down. It's just a nice graphical representation of volatility and what's happening. If we look at the daily chart here, we can see we were in the white is a tight squeeze and the red is just a standard squeeze. So tight, 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 kind of a standard squeeze, tight, tight, and then boom, squeeze fired here. Squeeze fired on this down day. Okay, and then boom, we were off to the races for 2 big up day, or at least 1 big up day, gap day. I don't know, it was really a gap with the rollover, but a big up move. Okay, so you can see squeeze is firing. It just gives me another sense of momentum because I like momentum. So that's how the squeeze worked. But if you want to read up on it, you can watch any of John Carter's videos on it. You can read Candy, who worked with John as well. So you can read her write up on it. She knows it as well or better than anyone here since she actually worked there. But you can get a sense of what that is. But typically you use it in conjunction with other indicators, maybe MACD or trend lines or support resistance, whatever. Nothing should ever be in a vacuum. You don't just, hey, squeeze is it. Okay, I like to see, boom, all of those are going the same direction. That's a strong momentum. So going back to the BA 112, okay, why would I do a BA versus an FB? Well, right now, the momentum is to the upside, and this is not rolling over. Okay, back here, we were starting to roll over, and even though we were overbought and we were rolling over, coming off of overbought territory here, okay, this would have made some sense, okay, to put on a BA 112. Now, right, after this bounce, it would just probably expire for making a couple $100, but we still have time. Okay, but you are still well above the 21 EMA. So I would like to see us break a 21 EMA, probably on like a daily or something. Okay, and that's where I would say, okay, we're rolling over a bit here. This is on 415. You could see on 415, we were breaking down here. Probably a good spot to put on a BA 112. Okay, and if momentum continues to accelerate to the downside, I would want to then move into an FB to capture more of the downside move, or you simply just, buy puts or whatever you want to do. So the BA stands for big ass. So there you go. Okay, it just means it's a long trap, which means we can go down a long, 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 long way. The FB is a wide trap, which means we don't have to go quite as far, but it's going to pay off on a stronger move to the downside. That's all. So there you go. If you want to check those out, you can check the video out on those. Okay. Squeak being politically correct, they're the fat boy trade. So either one, whatever you want to call it. The BA is a long trap, which means a long, prolonged down move that's slow would be great for a BA. An FB trade is a wider trap, okay, which is going to pay off a lot more money. So the BA is only 50 wide. It's only going to pay $2,500 in the trap per contract. The FB is going to pay twice to 4 times that, depending on how wide your chunky boy trap is on the FB. So, if you go like 200 wide, now it's going to pay off more like $10,000 in the trap. Okay, but you don't want on the FB, you don't really want to start it at the very beginning. You want to put that on in the middle of a downtrend, not at the very beginning, because it's not as wide of a trap. It's a fatter trap, meaning taller. So anyway, that's the answer to adding the BA112. That addresses the squeeze question from today as well. So we knocked out a few things there, so it gives you some idea. I'm going to answer the next question, and we'll throw one to Igor here. Another question was, why do I use a 111 versus a 112 in my IRA? Why don't I just use 111s? So the key here is, and this is also going to answer the question that somebody posted in chat today about, well, why don't you just add 2 more naked puts on the XL type of trade and make it a 444 type of trade? Okay. I don't want more naked puts. So my goal is to reduce the amount of naked puts as often as I can. The less risk tolerance you have, the less naked puts you should have. Okay, selling premium is a game that we take on that's going to make things, that's going to put risk in our portfolio, because we're selling premium, we're selling naked puts, and because you're selling naked puts, you don't have an unlimited downside, because as far as they can go down to 0 versus calls, where you do have an unlimited risk, because they can go to infinity, but you still have a good amount of risk to the downside. So the less puts I have, okay, the better I am, and the safer I am. So in an IRA, I want to be much more safe. I'm only shooting at 1.5% return in an IRA, which is risky enough as it is. That's 18% a year. That means I will outperform the average market over the history of the market. I will outperform it, and I will probably outperform almost every fund manager and mutual fund on planet Earth over the long period, okay, at 18%. So 18 still requires some risk, but I want to de-risk my portfolio, and I don't need to make 3%. So why take on all of those naked puts when I don't have to? So in an IRA, I trade a 111. I still make good money in the IRA. I still can make 1.5% a month. My strategy in an IRA, if you follow, I don't have necessarily a trade plan, but I do have the tracker. I don't really need a trade plan because it's essentially the same thing. It's the same trade plan, just a different risk profile and different goals. But I'm just putting on 85% 111s and 15% strangles. That's it. Okay. And 15% strangles in an IRA is not a lot, because you don't get a lot of leverage, because it's an IRA and I'm not getting the benefit of all of that margin leverage, because it's going to be at a much higher buying power that I'm using. So it's more like a 1-to-1. So strangles, not a ton of risk. I don't do a ton of strangles. I usually have maybe 1 or 2 strangles working in there, and mostly just 111s. And I just plot along, making 1.5% a month. And right now for the year, I'm up 7% this year, which is 1.3%. So I'm just under my 1.5% a month, but I did take a loss on a strangle. So, now I'll make it back. But anyway, that's the thing. So I'm right at 1.5% a month, pretty much in an IRA, and I don't need to add the risk. Okay. And I think somebody said something earlier about, adding more puts to something. Why don't you add more puts? I don't want to add more puts. Okay. My goal is to reduce the amount of naked puts as fast as I can. Okay. I won't put them on. I'll take the income, but I want to get out of those naked puts as fast as I can. Okay. 95% is fine. If I can take them off at 90%, that's okay too, if I can use that buying power for something else. And what Igor will typically do too is he may have multiple contracts of naked puts. So he may take off partial contracts instead of just closing the whole thing. So if your account's large enough and you're trading, 5 to 10 or so naked puts. So if you're doing a 10, 20-20 or something like that, fine. Or I'm sorry, a 10-10-20 or whatever it is. And you got 20 naked puts, great. Take off half of them when you can book profit. Now you have a 1-1-1 left over or something. But one way to, decrease your risk is to simply take off the quantity of naked puts. I think it makes sense to do that in an IRA. It doesn't make any sense for me to do that in a trading account where I'm trying to make 3% or more a month. Okay. I don't want to, if your goal in your trading account was 1% or 2% a month, then go to a 1-1-1. The less naked puts, the less risk that you're going to have on, okay? The less you have to worry about hedging or anything else. All right, so I hope that made sense for everybody. And I'm going to share one last thing, and then let's kick it over to Igor for the next question. And let me reshare. Somebody asked a question about the small account. Okay. And I don't remember what the question was, but why are you doing more strangles or something in my small account? I got to scroll up here and see what the question was. Okay, you're heavy, then I don't know. Why strangles instead of 1-1-2 if 1-1-2 are less risky? Okay, this is a small account, so the risk level is different in my small account. Okay, I'm willing to risk more in a small account than I am in my trade account, and then the trade account risks more than my IRA. So IRA is going to risk the least. Okay. Small account's going to risk the most. Why? Because it's a small account, and in order to grow a small account decently, you have to take on more risk. So my strangles allocation is higher in a small account. Simply put, okay, I'm going to take on more risk in there, so my strangle percentage is higher, and I have more naked puts, percentage-wise. So 30% of my account is between strangles and naked puts. There's a lot of naked going on in here. So the small account has got a lot of more risky trades. I'm also risking up to 5% of my net lick per trade. So I will I will take on more risk because it's a small account and I can afford to lose my small account, or my kids can afford to lose because they're just starting off and they're making money and they're going to keep dollar cost averaging into their trading account by putting money in every month. So even if they lose it, they can make it back. All right. So there is that on this one. Igor, a question somebody had posed earlier was, what, this was in the chat, and I'm not 100% sure if the person is even on here or they can clarify the question, because I was a little not clear on the question, but something about leaving long puts on if you take the short puts off for a profit. So let's just say, I assume the question on that was, you're talking about the put debit spread itself, not the naked puts, because we don't take the long puts off when the naked puts come off. But would you ever close, or would you be closing the short puts? And I think we almost all leave the long puts on as long as you can. This goes back to Igor's statement earlier of the put debit spreads hedge, the leftover put debit spreads hedge the newer trades. That's why we leave them on, is because they perform a hedge for the newer trades when they're young and they need a little protection. But would you take the long puts off for any reason in your put debit spreads, Igor?
I think so. I'm still trying to understand, what that question and exactly.
Yeah, I'm not 100% sure either.
So
But
if we just think about, right, the question is, would I ever close the longs? What that will do, that's not removing risk, right? If I have a 1-1-2 where I'm long one, short two, if I close the longs, which is the long leg of the put debit spread, that will leave me with net 3 short naked puts. And that's obviously not what we're trying to accomplish. I did think about, and we had this discussion before, instead of buying to close the naked puts, closing out the short leg of the put debit spread, which will kind of turn, um, it'll turn 112 into a ratio, right? So you're long one, um, closer at the money debit, put for a debit, and then you're short way out of the money, two puts naked, right? So it's a 1/2 ratio. The problem with that is that, again, everything has to be within the context, right? If you think the market may pull back, but we're not going to crash, and you have a pretty decent chance of catching the price somewhere between your long put and those out of the money naked puts, then that's a pretty decent idea. The reason I do anything as far as adjustments to a 112 is because I want to leave the put debit spread to act as a hedge to some of the newer 112s that are coming on, right? So if I'm going to turn a 112 into a ratio, it's not really a hedge anymore because you're still net short premium in a 1/2 ratio. So if the market is going to go down 15% in like 2 weeks, even though you have a really nice looking risk graph at expiration, your T plus zero is going to dive because, again, you're short two naked puts versus one long put that's closer at the money. It's not going to help in that scenario. So the reason I remove the two naked puts of the 112 is if the market is going to dive, right, that put debit spread, even though my reward is limited, right, to the width of that spread, it's still going to help out some of the newer trades that are coming on that have, maybe 2 days or 5 days or 7 days as far as how long these trades have been open. But if I convert my 112 into a 1/2 ratio, I'm adding risk overall to my overall holdings. And I'm not saying that it's wrong. It's just not something that I would do. I hope that makes sense. Right? Like Tom says, our goal is to remove nakedness, remove these naked puts as fast as you possibly can. And this way, the less naked puts you have on, the longer you could hold on to your positions. And if the market is going to push lower and you're already out of those naked puts, it's just a gravy on the side, right? Your leftover put debit spreads are going to kick in and potentially help you reduce some of that pressure that you will be taking on with some of the trades that you put on maybe last week, because those trades that are about to come off in the week or two are going to help you save your overall portfolio of the 112s.
Perfect.
Um,
Taking a look here at some of these other questions. One of the questions here, and this comes up a bit, and so Igor, I'll let you
mhm.
start with it, and then I can give my two take. And I think you already started to address it in the chat here, but what about switching from 95% profit taking on the short puts to like 85 or 90%? And does that make more sense? Because of the time it takes. And I know, Igor, you've discussed before, and the fact that the naked puts will come, they're going to decay quicker, obviously earlier in the trade, and then they really start to slow down. That last 5 or 10% takes a while. What's your thoughts on closing at 90 or 85 or something versus 95?
Yeah, so I saw the question, and the key word in that question was capital efficiency. I think that's where I saw it, and I don't think that there's a major difference between 95 or 90 or 85%, unless you're trading some size where it does make difference in dollars. But again, for me, everything has to be within context, right? So I look at my entire 112 campaign across all expirations that I'm holding, and I ask myself, do I need that extra put debit spread right now? If the answer is yes, right? If the market maybe the market feels a little funny, maybe there's some um, Fed decision that's coming in the next week or so. If as long as there is a reason for me to hold an extra put debit spread, if I'm at 85% on those naked puts, I'll go for 85%. Not because it's a better capital efficiency or any other reason other than do I need a little, or maybe I have um, another 112 that I'm going to enter in the next 2 days, right? So as I'm ramping up my 112s that are coming on, right? And that premium in some of those trades that already have matured is just not coming out for whatever reason, right? I will take at 85%. I'll take those puts at 85% just to kind of keep the chains moving, right? There's no reason to sit there and wait, right, for 3 weeks for that premium to go from 85% to 90%, because in those 3 weeks, I will have three new 112s that are kind of unhedged, if you will, right? So I'll go for lower um, percent on the premium on those far out of the money naked puts in exchange for having that put debit spread protect the next layer or two of the 112s that I'm about to put on in the next week or two. So I don't do it from a capital efficiency standpoint. I do it within the context of all of the 112s that I'm holding. If I feel like I have too many 112s there, I'm putting on, and I try to put on a 112 once a week, as long as the buying power allows for it. If I see that, no 112s are being harvested, or if I'm not removing any naked puts and I'm putting on 112s, then I'll go for lower percentage on those naked puts just to kind of keep things balanced.
I'll jump in real quick and pretty much echo the same sentiments here. And let's take a look at one of my trades. And here is here's a long-term 112 trade. Now it's at 92% profit. Now I trade a 336 for this particular account that I'm showing you right now. I paid 17, or I get paid $17 roughly, 17.75, 19, 17. So usually it's around $17, right? So $17, which means every 5% move is 85 cents. Okay. So just remember, every 5% is 85 cents of 17. 85 cents of 6 contracts times a 50 multiplier is $255. All right. So if I'm going to close at 95%, I'm leaving $255 of my original credit on the table. And I'm happy doing that. I don't mind. It gets me out. I will pay $255. Okay. Oh, you can give up 250. I'm really not even paying it. I'm just giving up $255 of my potential profit to close at 95, right? Which $255 on a $500,000 account here, okay, is 0.05 of a percent of my total account. It's almost nothing. Okay? And I don't want to belittle money, but it's not much of anything. If I closed at 90%, okay, I would be giving up an additional $255 again. So now I'm giving up 0.01 or something of a percentage, right? So 0.0 or 0.1 of a percentage. So a tenth of a percent if I closed at 90. And as Igor said, what would, you have to look at number one, I could close at 90%. I would give up another $255 for doing that, which is, again, not the worst thing. Is there another trade that I could put on that will allow me to make that up and more? Or B, am I trying to reduce risk potentially in my portfolio? Well, we just went through the charts and you saw that ES is in a pretty strong up move. So do you think you need to de-risk today? Probably not. Okay. Or at least it doesn't mean something couldn't happen tomorrow and the markets crash. But right now, the markets are strongly bullish. You've got the NASDAQ a little weak today, kind of flat, but most everything else is up because you've got a lot of the big name tech stocks are down. You've got Apple, Microsoft, Amazon, Meta, Google, and Tesla all are lower today. The market is being propped up by everything else. A little bit of Nvidia, some Netflix, and then Costco, Adobe, and some others out there. But the pretty broad move here. So do you need to de-risk and get rid of naked puts so that you can lower your overall delta? I look at it, to me, I look at it more of an opportunity cost of how much longer do I have to wait to get to 95%? And if I could use this do I need buying power today? Would I close it? I mean, I don't think it's a bad thing for me to close this today at $1.35 instead of waiting till 0.85. Okay, to do that, if I can get a good price on it, heck, let's get out. Okay, I just freed up a bunch of money, and if I look at, I freed up $14,000. If you look at the bottom right here, I freed up $14,000 in buying power by closing that put. Okay, so I closed that put and I freed up 14,000. Did I hit 95? No, but I got $14,000 in buying power. And what does that give me? Okay, that gives me, okay, I'm at 46%. I have plenty of space now in this account. Okay, we're up nicely today. I'm up almost $2,000 or so today in this account. Now I've got plenty of buying power to put on a new trade. Okay, we were almost at 90 days on that trade, which is about when we hit 95%. So we're at 89. So one more day, I would have been at the 90, which is give or take where we are. This trade now probably has 2 weeks to go before, of sideways to up movement before this thing gets to 8 to 95. Okay. But is there a better, in the next 2 weeks, what could I do to is there a good trade opportunity? So to me, it's an opportunity cost. Why not get out today, which I just did on that ES one, and I freed that up. So I hope that makes sense. Is either way you look at it, Igor's talking about reducing risk, changing delta. Okay, does he want extra protection for a new 112 he's going to put on today? Those are all great reasons. And then my other reason is, can I free up enough buying power to put on another trade that would make me some money? Am I willing to give up $255 to do it? Hope that makes sense.
I think I see a really good question, and I think that I could add a little visual to it. The question is, it's from Mac. If we are looking to remove the naked puts, why not take the naked put of the put debit spread? So it's not really naked put; it's just a short leg of the put debit spread at 95% as well, and just leave the long. Which in it kind of makes sense, but let me try to show you why it doesn't. And this goes back to what I said earlier. We're in the business of collecting a premium in exchange for risk, and if we try to remove as much risk as possible, we have to understand what we're paying to remove the risk that we just took on, and what are we going to end up with. I'm going to share my screen for just 2 minutes, just to show you why I think that it makes sense, but it doesn't. And hopefully this will start to kind of make sense. So this is a trade.
Are you sharing?
Are you guys seeing my screen?
Yeah, perfect. Thank you.
Okay, great. So this is a leftover, one of the trades that has 10 days to go. And in this trade, if you want to go back and look at the trade, this is a 2858. Which was a 112 in ES. And now I am left with, you can see that, I started this trade back on April 8th, and then I have removed the naked puts on June 11th for about they have, so the naked puts were at 44.50 and they've lost over 95%. So I closed them out and I'm left with a position that looks something like this, right? Now, this is a leftover put debit spread that will expire worthless 99.999% of the time, because over the next 10 days, you know, based on current implied volatility, we can see that the market is really not pricing in too much. And even if we move 2 standard deviations in the next 10 days, I'm not going to come anywhere near to where the strikes are for this leftover put debit spread. But the point is, if let's say my put debit spread is at 5150, 5100, right? This is a 50-point wide put debit spread. And I changed this column here from delta to original price. And these prices I copy from my brokerage statement. So I bought the 5150 for 76.25 and I sold the 5100 for 65.25. And if I was to close, right, the short leg of the put debit spread at 95 or 90%, right, I would have to pay about $6, right? This is ES with a multiplier of 50. So I would have spent about an additional $300 to close out the 5100, and that would leave me with a 5150, which in theory makes a lot of sense. But I already have just about $700 left in this trade. That's my profit. If I spend $300 or $400 to close out the short leg of the split debit spread, I will further reduce what I'm making in this trade, which is not really a big problem. But in the end, right? In the end, so most of the time, 99% of the time, these leftover put debit spreads will expire worthless. They will only engage in a market crash, if you will, because in the next 10 days, if the market moves 8% or more, then this is going to pay off. But if I'm going to spend more than half of what I'm making to keep the longs on and close out the short leg of the put debit spread, in the long run, not only am I going to cut my potential profits in half, right? But if you do this time and time again, in the end, this is a business that almost isn't worth doing, right? Because reducing the naked puts is great, but closing out the short of the put debit spread in theory makes sense, but I think we're just giving up way too much to make this trade worthwhile. Right. I hope this makes sense. And that's why we kind of have to draw a line. And, you know, I'm going to just add one more thing. Without having a visual tool, whether you're using Thinkorswim, Analyze tab, you're using Option Explorer, or maybe you're doing something inside of a spreadsheet that gives you the risk graph, unless you're seeing, right, where's my potential reward, how far we need to go to hit the max potential reward on this leftover put debit spread. And more importantly than anything else is your current running P&L. You want to know what your P&L today looks like, including all the adjustments you may be making throughout the cycle of this trade. So I know that I have about $700 that I'm going to make in this trade. If I spend any more, it's just to me, it doesn't make any sense. I'm not saying that it's right or wrong. I just think that to me, it will be spending too much and not getting enough. Because remember, when we put this trade on 71 days ago, we took on quite a bit of risk. And if I'm going to cut my reward just to leave a long leg of this put debit spread, I just think that in the long run, the money you're going to make is not worth the risk that we're taking on putting these 112s.
Yep. Good. And typically you paid a decent amount for that thing to start with. You're probably paid somewhere between 60 to 70 bucks to
Yeah.
begin with. So, and you didn't pay, you sold it for 60 or 70 bucks, or maybe even 80 bucks, and you paid 80, 90 bucks for the long. So it's expensive. So to buy it back is going to be expensive. I mean, that was a high naked put, and what are you going to pay for it? It is in my trade plan that it's a possibility to close those, but I would only do it between maybe 95 to 97% if I felt like I needed more of a hedge.
Yeah,
And
I agree. There's no right or
too
wrong.
expensive. Yeah.
It just, you may say that, oh, you know what, I don't mind spending, half of what I will make here just to have it on. Great. You know what? Do what is best for you. For me, let me just show you real quick. So for the next 3 days, and I don't count on it, but for the next 3 days, this is what I have left over. These are a couple of leftover put debit spreads. In order for these to work, the market has to go down, 7% in 3 days, and that's a crash in my world, right? 7% or more in 3 days. That's aggressive, and so I'm holding this, and while my 112s that I put on, 7 days ago, right? This is a trade that I put on 7 days ago. So a 7% move to the downside is not going to feel great, right? This trade alone is going to show a loss of about, $4,500, given that implied volatility is going to increase. A T plus zero is going to go much lower. So this trade is going to feel the heat. But these two left over put debit spreads on the move down 7%, they're not going to, save everything. But you know what? If that loss will go from $4,500 loss offset by this $2,300 gain, net, it's still going to be a loss. But this leftover put debit spread cocktail is going to kind of hold things together. Right. And yeah, I don't think that closing the short legs made a whole lot of sense for me. And in hindsight, if the market is going to crash, yes, I should have closed the shorts on these put debit spreads, but I'm fine holding this as is. And once these go out, the next couple of leftover debit spreads are in the June 28th cycle. Again, for these leftover put debit spreads to work, the market has to go down also a neighborhood of about 8% in the next 10 days. So if the crash continues, there's another tranche of these leftover put debit spreads. Again, these are just kind of hanging out there doing nothing unless we go down. And for the next 10 days, these two leftover or three put debit spreads are going to help out with some of the losses that I'm going to take on with trades that I put on 1 day, 7, 15 days ago. So they all have to work together, right? I just leave these put debit spreads, and if they're going to help, great. If they won't, I don't count on it. And as time goes, right? So after June 28th, I have August 16th, which is kind of weird right now because there's still a lot of time, right? There's 59 days to go. So that's 2 months, right? And we have these far out of the money naked puts that are, over 20% out of the money. And take a look at this, right? So in the last 35 days, these puts have lost just about 2/3, right? We would expect them to lose a lot more, but they're not decaying anymore. Even though the market's moving higher, these far out of the money puts, they're 20% plus out of the money, they're still holding up value. And eventually, in the next maybe 3 or 4 weeks, as these puts will gradually lose value, I'm going to remove these puts, and that's going to leave me with, right? Let me just highlight all the August 16 options. 16. What I got? I got 3 tranches here. So I'm holding naked puts. They're close to about 19, 20%. So in the next 3 or 4 weeks, I'm going to have 3 more 112s that are going to go up. And hopefully these naked puts are going to be closed out. And that's going to leave me with a bunch of put debit spreads that are currently at about 6% out of the money. And the cycle continues, right? As new 112s come on, the older trades that mature naked puts are coming off. Leftover put debit spreads are going to protect some of the newer trades. And we just keep going in that cycle until the end of time.
Perfect. I think that's a good plot to leave it for today. We're a little over an hour, but I think that's exactly right. And I think it answers your question, Chuck. I think you just asked the question we were just really covering there is we're leaving these put debit spreads on to cover our newer trades. They're not helping the trade that they're in. They're only really helping once those naked puts come off, that extra put debit spread. It's just helping the newer trades. It's helping to even out that T+0 line. It's really evening out the delta in the newer trades and providing a little bit of a protection. And to me, I think it's just worth leaving them on to give yourself that bit of protection. No sense removing it unless you really want that buying power and you're struggling to get new trades on and you need to do something and the markets are just still ripping to the upside. But it's nice to have that protection there. You've already paid for it in the trade. You've already, resigned yourself to paying for it. And once you close the naked puts, it's free now. So no sense squeezing a little bit more out of it, in my opinion. The protection is better. But that's, again, totally up to everybody here individually. So this is good. I think it was good to go through a bunch of questions with everybody. I hope this was helpful to you, and we'll do it again. So we'll do this one again where we can just go through and knock out questions for you guys.
Awesome, guys. Have a good afternoon.
Yep, sounds great. We'll let everybody go. We'll see you in the Discord channel. See ya.